Right now, every precious metals channel on the internet is telling you the same thing. The dominoes are falling, gold and silver are the only refuge, and they are right about that. But there is something critical that not a single one of them is telling you, and if you do not understand it before the next leg of this crisis hits, it could cost you everything you have built over the last 3 years. Today, I am going to tell you the one thing about silver that nobody in this space wants to say out loud. And I need you to stay with me until the very end, because what I am about to show you is a pattern that has played out before, and it is setting up to play out again right now in March of 2026. If you are new to this channel, welcome. This is the channel that connects the dots between the data and your money. I do not hype. I do not speculate without evidence. Every single claim I make is backed by publicly available data, and every reference is in the description below. If that sounds like the kind of analysis you need right now, hit subscribe and tap the notification bell, because what mainstream financial media will not tell you, I will. Now let me start by giving credit where it is due. Clive Thompson published a video this week called "The Dominoes Are Falling," and his analysis of the private credit crisis was excellent. He connected Blue Owl gating their $3 billion fund to Blackstone, covering $2 billion in emergency redemptions to BlackRock, invoking the gating clause on their $26 billion lending fund. He connected the collapsing labor market to rising oil prices to stagflation, and his conclusion was correct. Gold and silver are historically the most powerful assets in a stagflationary environment. But here is what he did not tell you. And this is the part that could save your portfolio or destroy it, depending on whether you understand it. When the private credit crisis reaches its peak, and we are not there yet, we are in the early innings, silver will almost certainly crash before it goes parabolic. Let me say that again, because I need you to really internalize this. Silver will likely crash hard before it rockets to levels that will make today's $87 price look like a gift. And the reason is something called the forced liquidation cascade. Here is how it works. Right now, private credit funds managing trillions of dollars are telling investors they cannot have their money back. Blue Owl is in outright liquidation, returning only 30 cents on the dollar. BlackRock invoked a gating clause that limits redemptions to 5%. Blackstone shareholders had to write a $400 million check to cover redemptions of just 7.9%. Now think about who invests in these funds. Pension funds, insurance companies, sovereign wealth funds. These are the same institutions that hold silver ETFs like SLV as part of their portfolio allocation. When their private credit holdings are locked up and they need liquidity, what do they sell? They sell what they can sell. And silver ETFs are among the most liquid assets in their portfolio. They do not want to sell their silver. They have to sell their silver. That is forced liquidation. And when forced liquidation hits a market as small as silver, the price does not go down gently. It crashes. Now, I am not telling you this to scare you. I am telling you this because it has happened before, and the investors who understood the pattern made fortunes while the investors who panicked lost everything. Let me take you back to 2008. In the summer of 2008, silver was trading at around $21 an ounce. The fundamentals were bullish. Supply deficits were building. Industrial demand was strong. Central banks were beginning to diversify. Sound familiar? Then Lehman Brothers collapsed in September. The credit markets froze, and silver did not rally as a safe haven. It crashed from $21 to $8.40 in less than 4 months. That is a 62% decline. Pension funds were liquidating everything they could sell. Hedge funds were getting margin calls. The COMEX raised margin requirements 3 times in 6 weeks. Paper silver was being dumped at any price, while physical silver was disappearing from dealer shelves. But here is the part that matters. Within 18 months of that bottom, silver rallied from $8.40 to $49.82. That is a 493% gain from the crash low. And the investors who understood that the crash was caused by forced liquidation and not by a change in fundamentals, those were the investors who bought at $8 and built generational wealth. Now let me show you why the same pattern is setting up right now. Today, silver sits at approximately $87 an ounce. Gold is at $5,165. The gold to silver ratio is hovering around 60 to 1, which is historically elevated. The COMEX registered silver inventory has collapsed to just 81 million ounces, and it is draining at a rate of 25.6 million ounces per month. The COMEX stress index is at 84 out of 100. In March alone, there are 52.63 million ounces standing for delivery against 86 million ounces of registered inventory. That is a coverage ratio that would make any risk manager lose sleep. But here is the critical data point that nobody is talking about. Drop the word margin in the comments if you already know where I am going with this. The VIX index, the so-called fear gauge, just spiked to 29.4. When the VIX rises above 25, the CME group historically raises margin requirements on silver futures within days. Higher margins mean that every leveraged long position in silver suddenly needs more cash to maintain their position. If they do not have the cash, their position is forcibly liquidated. And when thousands of leveraged longs are liquidated simultaneously, the price crashes, not because the fundamentals changed, not because silver suddenly became less scarce, but because the paper market mechanics force selling regardless of what the physical market is doing. And this is where the story gets truly extraordinary. During the 2008 crash, physical silver premiums over spot exploded to 30 to 40%. The spot price said silver was $8, but you could not buy a single silver eagle for less than $12. The paper price was fiction. The physical price was reality. The same pattern played out in March of 2020 when silver briefly touched $11.64. Physical premiums hit $10 an ounce. Dealers were sold out for weeks. The paper market said silver was cheap. The physical market said there is no silver available at any price. Now I want you to think about what happens when this forced liquidation cascade hits in 2026. We are starting from a COMEX registered inventory of 81 million ounces, which is a fraction of what it was in 2008. Shanghai Gold Exchange silver inventory has fallen 43% from 559 tons in November of 25 to 318 tons in February of 26. That is 240 tons gone in 3 months. The combined COMEX and Shanghai drawdown over the last 6 years is 161 million ounces, representing nearly 20% of the cumulative supply deficit. And here is where the math gets terrifying for the short sellers. If pension funds and institutions begin forced liquidation of silver ETFs, those ETFs must sell physical silver from their vaults. But the physical silver is already spoken for. Industrial consumers need it for solar panels, for electric vehicles, for AI data center infrastructure. Mining production has been falling. We are in the 6th consecutive year of a structural supply deficit. So what happens when paper selling accelerates but physical demand does not slow down? The paper price crashes, the physical price holds or even rises. The premium between paper and physical explodes, and that premium is the signal. That is the signal that the paper market is breaking. And when the paper market breaks, the repricing event that follows is not measured in percentages, it is measured in multiples. Now let me ask you something. Comment your answer below. Do you think silver will dip below $70 before it hits $150? I genuinely want to know what you think, because the answer to that question determines your entire strategy for the next 12 months. Let me give you the framework that I use. When forced liquidation hits, the crash in paper silver typically lasts 4 to 12 weeks. During that window, the gold to silver ratio spikes dramatically because gold holds better during liquidity crises. If gold stays above $5,000, which is widely expected, and the ratio spikes to 70 or 80 to 1 during a liquidation event, that implies a silver price in the $65 to $70 range, a 20 to 25% pullback from current levels. That is the buying opportunity that the smart money is waiting for. Now, here is what JP Morgan knows that most retail investors do not. JP Morgan has been accumulating physical silver for 15 years. They have built the largest private silver holding in modern history. And they did not build that position by buying silver when it was expensive. They built it by understanding the cycle. Paper crash, physical accumulation, paper crash, physical accumulation. Every forced liquidation event is a transfer of wealth from leveraged paper traders to physical holders with patience and cash. That is not conspiracy. That is documented in the CFTC Commitment of Traders reports. And this brings me to the most important part of this entire video. The Federal Reserve is trapped. Inflation is running at 3% on core PCE. The Fed cannot cut rates without reigniting inflation. But the economy is shedding jobs. Over 1 million fewer Americans are working today than a year ago, according to the Bureau of Labor Statistics' own data. Oil is surging because of the Iran conflict. Private credit is gating. The 60-40 portfolio is broken because stocks and bonds are falling together. The Fed has no good options. And when the Fed has no good options, they eventually do what they always do. They print money, they bail out the system, they expand the balance sheet, and when they do that, the money supply expands, the dollar weakens, and precious metals go vertical. But there is a gap between now and that moment. And in that gap is where the danger lives for unprepared silver holders. So how do you position for this? The answer depends on who you are. If you are holding physical silver, you do nothing. Physical silver in your possession cannot be margin called. It cannot be gated. It cannot be frozen by a fund manager who decides you cannot have your money back. Your physical stack is your insurance policy, and this is exactly the moment it was designed for. If you are holding silver ETFs or paper silver, you need to understand that your position is subject to forced liquidation by other shareholders. When the pension fund that holds SLV alongside you decides it needs cash, your ETF gets sold whether you like it or not. The price drops, your position drops, and if you panic sell at the bottom, you have just transferred your wealth to the institutions that will buy it back from you at a discount. If you are leveraged in silver futures, you are in the highest risk position of all. A margin call does not care about your thesis. It does not care about the supply deficit. It does not care about the gold to silver ratio. It cares about one thing, cash. And if you do not have the cash when the call comes, your position is liquidated at the worst possible moment. Hit the like button right now if this framework is making things clearer for you, because what I just described is the single most important dynamic in the silver market, and almost nobody is explaining it. Now let me bring this home. There are 3 types of people watching this video right now. The first type is the person who just heard me say silver might crash 25%, and they are terrified. They are thinking about selling everything tomorrow morning. If that is you, I understand your fear, but I want you to think carefully. Are you selling because the fundamentals changed? Or are you selling because someone just told you the paper price might go down temporarily? The fundamentals have not changed. The deficit is real. The inventory is draining. The industrial demand is accelerating. The second type is the person who is confused. They have been told by every channel that silver is going to $100, and now I am telling them it might go to 65 first. If that is you, welcome to how markets actually work. Markets do not go in straight lines. They go through cycles of fear and greed, and the transition from fear to greed is where the biggest wealth transfers in history take place. The third type is the person who already knew everything I just said. They have been quietly building cash on the sideline, waiting for the forced liquidation event that they know is coming. They are not scared. They are not confused. They are positioned. They have physical metal locked away. They have cash ready to deploy when premiums spike and paper prices crash. And when the dust settles and the repricing event begins, they will be the ones who bought silver at $65 on its way to $200. Which type are you? Tell me in the comments. If this video changed how you think about what is coming, share it with one person who needs to hear this before the next wave hits. Subscribe, hit the bell, and I will see you in the next one, where we are going to break down exactly how to read the COMEX data in real time so you can see the forced liquidation coming before it arrives. This is not financial advice. This is data analysis and my personal interpretation of publicly available information. Every individual must assess their own circumstances, risk tolerance, and investment objectives. Every reference is in the description below. Stay sharp, stay patient, and whatever you do not let the paper price shake you out of your physical position. The storm is coming, but so is the sunshine on the other side.